Good afternoon and welcome. My name is Rod Taylor and I'm the Division Administrator for the Community Engagement and Finance Division within the Department of Treasury. We'd like to thank you for joining us for our fourth COVID Updates and Resources for Local Governments webinar series. This is being presented in partnership with the Michigan Municipal League, the Michigan Association of Townships, and the Michigan Association of Counties. We've held previous webinars in April and May that covered a very diverse set of topics that's important local unit of government. You can go back and watch these previous webinars by visiting the Treasury COVID webpage, and I'll leave a link in our chat box so you can click on that if you choose to. Additionally, there's a link at the end of the webinar that you'll be able to follow. Today, if you're receiving beeps during the presentation, make sure you click on the chat feature, which is in the upper left-hand corner of the web screen. You can also use this feature to ask questions during the webinar. We hope to be able to answer a couple of these questions at the end today. One important note on the chat box, please only use that to ask questions, other we get overloaded with the information that's coming in through that feature. Today, if you'd like to follow along in the presentation, we'll provide a link in the presentation for the presentation in the chat box so you can download that. I think Kayla's already done that, so you should be able to click on that link and then be able to download the presentation. Additionally, we'll be recording the presentation, and everyone who registered will receive an email within 24 hours that includes a copy of the slides and a link to the recorded presentation. Additionally, both the slides and the recording will be available on the Michigan Department of Treasury's COVID website. After you exit the presentation today, you'll be asked to complete a survey. Please take some time to do so, as this feedback is important to the continued development of these webinars. For those that attended previous webinars, you'll see that we've added a few new questions this time. These questions will help us understand some of the issues local governments are facing. And today's questions focus on short-term cash flow needs and understand the impact of summer tax collection. Now that our housekeeping items are done, let us get started. I'd like to introduce our MC for today, which is Heather Frick. Ms. Frick is the Director of the Bureau of Local Government and School Services within Department of Treasury. Ms. Frick has served as the Executive Director of the State Tax Commission, is a Michigan Advanced Assessing Officer, and a Personal Property Examiner, and also is a member of the State Board of Michigan. I'll now turn it over to her. Heather?
Thank you, Rod. Good afternoon, everyone. As Rod indicated, my name is Heather Frick, and I am the Director of the Bureau of Local Government and School Services with the Michigan Department of Treasury. We are pleased to be able to come together with the Michigan Municipal League, the Michigan Association of Counties, and the Michigan Townships Association to host our fourth joint webinar series. We understand that this is a unique and difficult time for local governments, which is why we want to continue to be a resource and provide information and strategies to assist local governments in navigating these extraordinary times. It is my pleasure to introduce Eva Cole, the Division Administrator for the Revenue Sharing and Grants Division, who will start us off by discussing the revenue sharing impacts. Eva?
Thank you, Heather. As Heather indicated, I'm the Division Administrator for the Revenue Sharing and Grants Division. We handle all revenue sharing payments. We handle any kind of grants that are issued by Treasury, and we also do the personal property tax reimbursement calculations for the local community stabilization authority. So to start things off, we'll start with personal property tax reimbursements, and everyone's big question is, well, what is happening with them? So for the first overall, everyone for the 2019 calendar payments should have received the payment in October, on October 20th of 2019, February 20th of 2020, and the local community stabilization authority had just issued the May 20th payments, and that would round up for the 2019 PPT reimbursement process. For the 2019 personal property tax reimbursements, we have a lot of information out on our website. Our website is located at www.michigan.gov/PPT reimbursement, and that will take you directly to our PPT page, and there's a lot of information out there. But if you go, I don't know if we have any schools on here, there's a section for school districts, and then there's a section for other municipalities. And we have similar reports for school districts as we do for other municipalities, but there's a report out there that gives you a distribution by payees for the 2019 reimbursements. There's a column that shows you the October payment, the February payment, and the May payment. And then we have a report out there that will show you the reimbursement breakdown by millage. We have one updated for the May, and we also have the ones that have the October and February. And then there's another link out there that has the reimbursement calculation where you could click on that and sort of go see how is my payment calculated. So we have all that information out on the web, and it's very useful. If you go out there and have troubles with it, make sure you give us a call. Our contact is treasurorderppt@michigan.gov. That's our email address, or you could call 517-335-7484. For the 2020 personal property tax reimbursements, that is what we're currently busy working on. Whoops, I actually jumped ahead a little bit. For budgeting for your 2020 personal property tax reimbursements, pretty much what we're telling people, if you plan on having taxable values and millage rates, if they remain constant, you can roughly project that you should get roughly the same amount you received in the prior year for your 100% calculated loss amount. If your taxable values and millage rates change over time, then you potentially could go out to our website and use that calculation spreadsheet and put in the different millage rates and taxable values that you are going to have, and that should help calculate a projection of what you should potentially get for your 100% calculated loss amount. It is important to keep in mind, though, that municipalities' PPT reimbursement will be affected by whether or not a tax increment finance district files for their reimbursement. So if in one year a TIFA files and gets reimbursed, and then the next year they don't, if they don't in the next year, the municipality's PPT reimbursement will probably be higher. But if they don't file in the previous year and then they file into 2020, your payment will probably be lower. That's just something to keep in mind. For the 2020, this is what we are working on currently, hoping to get everything calculated by beginning of October so we can get the payments out October 20th. There are two things that we're asking municipalities to do right now. We need you to go out on the website and review the 2012 to 2019 millage rate comparison report. If you find some millage rates that are incorrect, you need to file Form 5613 to correct those millage rates, and that form is due by August 1st of 2020. And then we're also asking everyone to review the 2020 personal property summary reports. Equalization directors should have provided them to the treasurers late May, beginning of June. If you happen to notice any problems with the taxable values, you should work with your equalization director, hopefully sooner rather than later. If you can work with them, they can revise the PPSR and send it back to us so that we get the correct numbers in. However, if you wait too long, which I'm thinking probably beginning of September, because we'll already use the numbers in our calculation, you'll need to file Form 5651 to correct some taxable values, and those are due March 31st. And if you do correct something, those then go into the correction process, and those payments will not be issued until May 20th of 2021. Now we're going to jump onto revenue sharing and what the impact of COVID events have had on the revenue sharing. As you can see from this chart, fiscal year 19 through 21, revenue sharing is going down slightly each year. And if you look at the change from the most recent forecast for fiscal year 20 and 21, there's a relatively big change in 20, but then based on the revenue projections and the May consensus conference, so 21 actually has a bigger effect on revenue sharing payments. I believe for fiscal year 20 overall, the percentage change is around 4.7%, and the fiscal year 21 drop in revenue sharing is around 9.4%. And this is made up purely of the sales tax and reducing your constitutional revenue sharing amount. A lot of people want to know, how can I find information regarding revenue sharing payments? We have a website. It's www.michigan.gov/revenue sharing, and it has a lot of information out there. There's sections for cities, villages, and townships and counties. We have projections. We have annual projections in a report format, and we have bi-monthly estimates, and then we also have county projections out there in a monthly format. The big thing to look at when you go out to the bi-monthly estimated payments for local government is, when you go out here, there's a note on the very bottom of the form, and the very first sentence will tell you which months of this chart are actual and which months are projected. So for the one we're looking at, October, December, February, and April amounts are actual, which means that the June and August amounts are projected amounts. Then after that, in this paragraph, the second sentence identifies how the remaining months are projected. So it tells you what it's based on. Like currently, they're based on the 2020 appropriation and the May 20 consensus revenue estimates. They're going to have another conference in August, and so when we update then, that would change to say the August 2020 consensus revenue estimates. And the very last sentence identifies when we have updated the projection. We updated these on May 15th, which was the date of the consensus conference, and we try, when we ever have a revenue consensus conference, we try to get these projections up on the same day. The other thing I would want to tell you on this chart is based on the state's fiscal year. So October, this is fiscal year 20, so this would be October 2019 through August of 2020. If you have any questions, like I said before, definitely give us a call or email us, and we will try to answer them as soon as possible. So that's all I have for revenue sharing and PPT.
Thank you, Eva. Now I'd like to introduce our next speaker from the Tax and Employer Services at the Michigan Unemployment Insurance Agency, Daryl Hunter, who serves as the Division Administrator. Daryl is going to discuss the different programs UIA has to offer, and with that, I will turn it over to Daryl.
Good afternoon, all, and thank you very much. Again, I'm Daryl Hunter, Division Administrator for Tax and Employer Services. We also have with us Yakima Everett. She is our ombudsman over the Tax and Employer Services. And what we are in charge of is all of the taxes that employers pay for unemployment. So in our area, we have, Michigan has about 220,000 employers. And in that, we service those employers. In that program, in that area, we have a program, what we call, it's under LEO, the Department of Labor and Economic Opportunity. We've been under so many different departments previously. It was TIA and TED, and now that gave birth to LEO. So we are there, housed under that area. We have a program that we want to discuss with you, and that is called the WorkShare program. The WorkShare program is something that we had sitting on the shelf for years and years. Michigan got involved with it back in 2014 or 15. And it's an excellent program that was developed during economic hardships. We thought that it would have been something during the recession that we had back in the early 2000s that we could have used. And in that program, it helped employers and employees retain their talent. So WorkShare is a state of Michigan program that can help employers retain their employees and restart their businesses during disruptions in operation. So before the COVID disaster came, the pandemic disaster came, what we tried to do was introduce a program and have employers use this program so that instead of them laying off their employees, what they could do is use this WorkShare program that will give them a percentage of unemployment and a percentage of their working as well. And then what happened was that during some of the executive orders, the governor had to close down many employers. So in that time, the employees went on complete unemployment. So what we're doing with this is it allows the employers to bring back the employees working into Michigan, into their positions. And what they do is they just reduce their hours. And while the employees collect a partial unemployment benefit, they will also get their regular work hours and their work salaries and wages from the employer. The work share has traditionally been used to, as I said before, by employers to retain their work and avoid the layoffs. So as Michigan restarts its economy, employers are urged to use the program to bring the employers back into employment. With the workshare program, an employee works a fewer hours, as I said, in a week, receiving a reduced salary from their employer, but it gives a percentage of the UI benefits. And one of the big things about it is that, and I know this is one of the questions, the employer also gets the $600 federal pandemic unemployment compensations, which we call FPUC. Now, that's not to be mixed up with the PUA money, which is for all of those employees who are not eligible for unemployment recently. So those would be those 1099, the business owners and whatnot. It happens to be $600 also, plus some other money. But this is what we call the FPUC money. And that is going to be good. And all employees will receive that no matter what percentage, and I'll go into the percentage of unemployment that they receive. And that goes all the way through July 2020. So it's a great incentive for employers to get the workforce back. So how it works, as we said, is that an employer can bring back the employees at the reduced rate, and the employee will receive more money than what they usually did if they were on regular work hours sometimes, and even if they were on regular unemployment. And like most importantly, they receive more money than they would if they were to remain on standard unemployment, as I said. This allows the employer to start their business at a reduced capacity, and then as they wish and need, the employer can increase the work hours and reduce the unemployment hours until the person or the employee is working full time. Some of the eligibility requirements here, the governor, through her executive order and through some of our things, we waived them. But what the eligibility requirements are for the employer is that the employee has to have an active UIA account number and must be what we consider the liable employer. And most employers know what that is, that they pay their quarterly unemployment, their quarterly unemployment wages. And they also send information in to us quarterly, letting us know that these employers are what they consider employed for their things with their social security numbers and whatnot. Employers must obtain approval for any applicable collective bargaining unit representatives, so if they're UAW or whatnot, they have to do that. This is also a good program for reimbursing employers. So state of Michigan employers are what we consider reimbursing employers. So those municipalities, if you work for a city, if you work for a nonprofit, if you work for other municipalities, those are reimbursing. So they don't have to actually pay a quarterly tax, but what they do is they actually provide the wages of the employees that are eligible for unemployment. That's how we know to pay the wages. We know how to pay the benefits because you report the wages. And employers participating in work-share cannot modify the employee's fringe benefits. So that means if an employee is gets regular sick leave, holiday pay, or those type of things, that cannot change. They must continue to get that in addition to being on the work-share program, because we want the employee to not have as much disruption as possible, unlike if they were on full unemployment. As far as the employee's eligibility, they must make sure that they have earned enough wages to meet the monetary eligibility in order to establish an unemployment claim. They can be part-time employees or even new employees. As long as they're eligible to receive unemployment benefits, they can be eligible for employers. And employees on previous UI claims must continue any other claims that they have. So if they're on unemployment currently and the employer decides to hire them as on the work-share program, they must continue their previous claim and come into the work-share claim. And then what happens is that the employer is the one who certifies. So all the employee does is go to work and then they receive the money. And as we say, the advantages are that it minimizes and eliminates the complete layoffs of the employees. Businesses can reduce the employees' hours and reflect the decrease as they want based on the business demand. So it can go up and down. If you decide that you want to plan for 10% or 60%, I'll get into those later on. But you can do that during the 52 weeks that you have. It enables the business to retain the employees and avoid expenses in recruiting. It saves money and all those other things, and it keeps the fringe benefits. So the flexibility of the employers is that what happens is that the employer can pick as many plans as they want to have, but they have to have at least 2 employees in each plan, and they can have as many as they want to. The employers have flexibility to stop within the time of the application, and the employer must reduce the hours of the employee for 10% up to 60%. So 10% is like a half a day, and 60% will be 3 days, which is 3 days in a normal 40-hour work week. If the employee works more than 40 hours, they're not eligible for work share. The employer does all the certification weekly or bi-weekly, depending on how they want to, for the employee. And as I said, all the employee does is just go to work. The employer could bring 10 employees back at a 20% reduction, and then they can also create a plan where they bring back 20 additional employees at 50% reduction, and then they can lay off people that they want to not bring back. They don't have to bring them back. And then they can also bring back people full-time and not put them within the work-share plan. We just ask that if you have a work-share plan, that you treat everybody on that work-share plan at that time. If you have to lay off everybody on that work-share plan, then what you do is terminate the plan and have to do that. But you have to treat everyone equally. Oh, sorry. I didn't read that one at first. A work-share plan, as I said, can go up to 52 weeks. And at any time, you can discontinue it and reactivate it during that time as the employee deems necessary. And you will have to communicate with the employees that they're going to be on work share, because what happens is that after you have told them they're going to be on work share to come in, we send them a letter, and it gives them all of the benefits and what's going to happen for that. And we ask that you do it during the week of or a future week when you apply for the program. So let's say if you wanted to participate in the program as soon as this week, you can have that done, and it goes through this Saturday. You have to have it done by this Saturday because the actual work week begins on a Sunday. Some of the exclusions, as I said, is that the employee cannot work more than 40 hours that week. If the employee does work for more than 40 hours that week or more than the plan that is agreed upon, then all the employer does is that when they're certifying their employee that week, they just don't certify them. They just skip over them and do something else and then put them on for that next week. Also, the employees cannot be seasonal, temporary, or intermittent employees. They have to be regular employees in order to qualify. And work share benefits, I saw that was one of the questions too. Work share benefits are taxable income, but there's no deduction during work share. So therefore, the employee has to govern themselves accordingly when it comes to the next year's tax year and make sure that those wages that they receive under work share are going to be claimed. One of the things that I mentioned before is the certification. This is what it looks like for the employer to do that. The employer just goes in and certifies their plan in there, and they're going to ask them a couple of questions after they've gone ahead and signed up. We had some information that's going to be on our website that I'll tell you about. You go through your website, and we can give you that information as well. But this is how you certify the plan. It's real simple. This is a very simple program. And then this is some information on terminating. If you want to terminate the plan after the week is done and you realize that you don't want the person to work on a 20% plan or 30% plan, you terminate it, and then you can skip a week, or you can just start the next week up and start another plan. But remember, an employee cannot have more than one plan at one time, even if it's an unemployment plan. We also have a program called Employer File Claims, which is not with WorkShare, but the employer can go ahead and file the claim for the employee. And that's a separate program, but we do offer that in UIA as well. There's another thing that I wanted to tell you about is the WorkShare and the Paycheck Protection Program, which is what the PPP, that's the big thing that everyone's talking about now. You can have both, but you have to keep in mind that the employers that are on a PPP plan can still participate in WorkShare, but the program's design needs to be considered when the goal of PPP is forgiveness of the loan. So you can't double dip. You can't say, oh, I get the PPP loan, you put the people on WorkShare, and then now they're receiving WorkShare while you're supposed to be paying them the full-time hours. So you need to really check the requirements of the CARES Act for the Payment Protection Program to make sure that they're not conflicting. And here, one of the things is that the requirements for the PPP is that 75% of the PPP loan must be used for payroll costs to be eligible for forgiveness later on. The loan forgiveness will be reduced if salaries and decreased salaries and wages by more than 25% for any employee that made less than $100,000 annualized in 2019. And the employers have until June the 30th, 2020 to restore full-time employment and salary levels for any changes made between February 15th and April of 2000, which is when the pandemic really kicked off. And then quickly, we can go over, this is just an example. You have an employer here that he's a manufacturer, he wants to restart, and he's lost revenue for, he's experienced a loss of revenue for the next 12 weeks, but wants to reopen his business. He has 100 employees and they were laid off due to COVID. What the employer wants to do is bring them back on at 70% capacity. So what happens is that they will work 70% of the week, and then they will be laid off for 30%, and that means a 30% reduction. So that's what's going to happen with this area. And so here are the calculations. If the employee works $1,000 a week, which is somewhere about $50,000. So anything over $17 an hour, $34,000, $35,000 a year, they will be getting a maximum of ordinarily $362 for their unemployment. So at this rate, the employee will will work at that time, and then we'll give a 30% reduction, which means that we will take 30% of that $362, plus they will earn the $700 for the hours that they work for their employer. Plus, as we said, they get that $600 federal money. So with that, they're going to get a total of $1,408 when they're on work share, as opposed to just the $962, which is the $362 plus the $600 full unemployment for on there. So there is a benefit for the employer to bring the employees back based on restarting the business. It's an incentive for employers to tell the employees, hey, come back because you could actually make more money working. And these are just some more of the things that we said. Again, you can have the plans from about 10% to 600. The length of time that an employer is in business has been waived by the governor. She also waived that they don't have to be current on their unemployment taxes. So sometimes employers are in their reserve and they're what we call a negative reserve, or they owe us reports and whatnot. We ask that they give us the reports, but if they're in collections, it doesn't matter. We waive that as well. Regular part-time employees are now eligible. And remember also that the employee will get their UI benefits plus that $600 through July 2000 of this year, July 30th of 2000 this year, and 100% of the work-share program. If the employer is using work-share, 100% of that money will be paid by the federal government. So that's a positive thing for employers to say, hey, I don't have to necessarily look for my quarterly tax rate to go up, and the money will not come from their reserves, so they will not be penalized. So in conclusion, as we get Michigan started, we want to make sure that the employers really know about this program, because this is really the avenue that every employer, in my opinion, all 220,000 employers should really consider this plan, even if you happen to be the CEO or if you happen to be just a person at the grocery store that's a bagger. As long as those hours are reduced during that week, they will be eligible for work share. And if they're eligible for work share, that will get the economy going and get people to want to come back to work. I know I've seen my questions coming up. I will remain online. If you have any more questions that are not being asked in the chat room, I will remain on there. That's it. These are just frequently asked questions. Also, although what I do want to show you is that we have a website, which is michigan.gov/workshare. You can go there, and if you have any questions, you can either email us at that. You can get a copy of this presentation, and you can get a copy of some of our frequently asked questions, our fact sheets, All of the do's and don'ts are there, and you can also call us at our ombudsman number, which we have Ukema Everett that's on answering the questions probably in the chat area now. She will also be having someone to do that. Also, each employer has what we call a web notice in their account. They can also ask questions to the web notice, and we will get back with them within 24 hours. And now I want to introduce to you Peggy Noll, for the chairperson for the State Tax Commission.
Good afternoon. Yes, thank you. Our MC has some technical difficulties, so I'm going to introduce Peggy Nolte. She is the chairperson for the State Tax Commission. Peggy, go ahead if you're ready.
I am. Thank you for having me. I have 3 small items to speak on today, and the first one is Tax Day in Michigan. Tax Day in Michigan is December 31st. So property values for the 2020 tax year are set effective December 31 of 2019. Assessments were set, county equalized in April, and state equalization occurred on May 26th. Those assessments then become state equalized value. The state equalized value and taxable value for 2020 will show on both the summer and the winter tax bills. Most recently, Midland and surrounding counties have experienced some heavy flooding and loss of structures. Valuation changes to any of those areas will not take effect until the year of 2021. So please make that known. July and December board do not have any authority to change any values. Again, December 31st was tax day, so if there was a fire on January 1st, there is no change for that 2020 year. The second item I'm speaking on is 2 years sales studies. For equalization and valuation purposes, the sales study period range is from April 1 of 2018 through March 31st of 2020 for the 2021 tax year. These sales are used for analyzing the sales ratio studies, land value studies, and economic condition factors for appraisal studies for the 2021 year. It's hoped that local and county governments have kept assessing and equalization staff employed during this time so that this preliminary work can be done, even if it is from home on a computer, easily able to be done at that location. The third item is what to keep an eye on. During COVID, there have been limited sales transactions for the last couple of months. Residential seems to be coming back quite rapidly, and with using the 2-year sales study, that should not be an issue. But I'm sure local assessing staff will be analyzing that for these coming times. Commercial and multi-tenant properties. Those are the ones we may see some changes for 2020 or 2021 in. Vacancy may be up at the end of the year due to small businesses possibly having to close during this period. So again, the assessing staff will be looking at those, I'm sure, as of tax day to see if property values are in line. The last item I'm speaking on is Public Act 660 of 2018, commonly referred to as the Property Assessing Reform. PA 660 provides a statutory framework to ensure proper assessing in order to guarantee the highest quality assessments for taxpayers as well as local units. This act defines requirements for a local unit to be determined to be in substantial compliance with the General Property Tax Act. It provides timetables for audits and follow-up audits. It provides a process for bringing a local unit into compliance. It also mandates training for all local border reviews and allows units to combine border reviews for efficiency purposes. A majority of these provisions don't go into place until 2022. However, you as leaders can make sure that your local unit can begin to prepare by making sure that they're in compliance with the current AMAR standards. And all of the units across Michigan have already been through this process. So now's the time to make sure that you have that qualified assessor and that you're receiving quality work from your assessor. By ensuring accurate, uniform, and equitable assessments across the state, reform will significantly reduce unnecessary costs associated with incorrect assessments. It is hoped that all local and county governments recognize the importance of keeping these departments staffed with qualified and certified professionals, as these people are the boots on the ground for your municipality. Property tax is your major source of income for your budget, so having the dedicated and knowledgeable assessors on staff is a benefit to everyone. Thank you.
Thank you, Peggy. Next is David Buick. He is the SDC Executive Director and the State Division Administrator for the Property Services Division here at the Department of Treasury. David will be sharing key information about the property tax calendar and information for assessors. David?
Good afternoon. Thank you. This morning, the State Tax Commission, in their meeting, approved guidance for executive order for the 2020 July Board of Review, which is talked about in Executive Order 2020-87. I'd like to briefly go over the executive order and some of the provisions and some of the information that's in the guidance. Sections 1 and 2 of the executive order provide that late submissions from the March Board of Review to County Equalization and the County Equalization process to the State Tax Commission will be considered timely. It also gives the County Equalization Department permission to equalize based on an assessment roll prepared by the assessor if the County Equalization Director did not receive a roll certified by the March Board of Review. These provisions are pretty much done because we've already completed state equalization. Section 3A provides that boards of review that were not able to complete their duties set forth in sections 28, 29, and 30 of the General Property Tax Act, that being the March Board of Review, must meet on the Tuesday following the third Monday in July to hear protest. Section 3B provides that in addition to the purposes set forth in 53B of the General Property Tax Act, boards of review acting in July must also meet to hear protests under Section 30 of the General Property Tax Act and any other matters that are properly before a March Board of Review under Section 30 of the General Property Tax Act. These provisions show an intention to ensure taxpayers are provided due process, including those who may not have been able to appear or protest before the March Board of Review due to COVID-19. Taxpayers are not required to provide proof that they were unable to appear at the March Board of Review due to COVID-19. As long as there was no protest or decision by the March Board of Review on the same issue, a taxpayer has a right to protest to the July Board of Review. If the July Board of Review has no regular business under Section 53B, local units should still hold a July Board of Review for appeals provided by the executive order, that is, appeals that could have been heard in March, in order to provide due process and to ensure that each local unit is able to complete duties of the March Board of Review. As a reminder, July Board of Reviews acting as the March Board of Review are to consider valuation and status of the property under appeal as of tax day, which is December 31st, 2019, when making their decisions. Since there are differences in the March and July Board of Review authorities, we strongly encourage Board of Review members to review guidance on the SDC website to make sure they understand their authority, and when they hear appeals of qualified errors and other matters allowed under Section 53B, that gives the Board of Review authority to consider prior tax years. Board of Reviews must issue decisions on any protest made under Section 30 by September 1st, 2020. Section 3C provides that boards of review meeting in July, as described in Section 3A and 3B, must allow a taxpayer to file his or her protest before the Board of Review by letter without personal appearance by the taxpayer or his or her agent. Section 3D allows an owner of any assessable property who disputes the classification of a particular parcel must notify the assessor and may protest the assigned classification to the Board of Review acting in July. Section 3E allows an owner or an assessor to the ability to appeal a classification decision of the July Board of Review by filing a petition with the State Tax Commission not later than September 1st, 2020. Section 3F makes it very clear with the executive order, it does not provide for a rehearing or reconsideration by the July Board of Review of a protest, request, or other property tax matter that was previously denied by a March Board of Review. Section 6 provides that the Boards of Review meeting in July to hear protests must provide notice in a manner required under the Open Meetings Act, as modified by any applicable executive order that may be in effect at the time notice is required. This provision of such notice satisfies the minimum requirements of due process. There are no specific notice requirements for the July Board of Review, but public bodies must always post notices in accordance with the Open Meetings Act. Executive Order 2020-87 does not require the reissuance of assessment notices. Well, there's currently legislation moving through the legislative process that may affect some of the property tax calendar dates. As of this time, the property tax calendar has not changed and those dates still remain effective. The other thing is we may want to keep in mind there's a couple other executive orders that affect property tax assessment. Executive Order 75 allows for the remote participation in public meetings. This is effective through June 30th, so we don't know if it'll be in effect to allow remote participation for the July Board of Review. We'll have to wait and see if the governor reissues that executive order or extends it. Executive Order 77 allowed assessors to return to work effective May 7th. Executive Order 103 provides for the alternative notice methods for tax abatement statutes, and that executive order is in effect till June 30th of this year. That concludes what I have. Thank you.
Thank you, Dave. Next is Howard Heidemann. Howard is the State Division Administrator of the Tax Analysis Division at the Department of Treasury. Howard will be sharing information about foreclosure prevention and mischief forms. I'll turn it over to Howard Heidemann.
Howard, maybe you have to unmute yourself. Howard may have gotten disconnected. Heather, can we introduce Steve, and we'll jump to Steve and then jump back to Howard if he gets reconnected?
Yes, we will move ahead to Steve Abita. I'm happy to announce Steve participating. He is Tribunal Chair for the Michigan Tax Tribunal, and Steve will be going over deadline extensions, small claims, and updates from the Tribunal. I will turn it over to Chairman Bita at this time.
Thank you, Heather, and thank you, everybody, for participating today. Some of the information that I'll be talking about is available on the Michigan Tax Tribunal website, which is www.michigan.gov/taxtribe. And I would recommend that you look at that. And also, if you haven't signed up for one of our newsletters, it comes out with updated information as either executive orders change or some other directives have changed. And so it's useful information. There have been some deadline extensions, as you know, and I'm going to try to crystallize these as quickly as I can. When the state of disaster was declared, The tribunal responded with an extension of time to file answers for cases that had been filed already. With the rescission of the stay-at-home order, that timeline has changed. So beginning November 2nd, if you had a stay, you would now have 20 days or 21 days, depending on what the rules required for submission of an answer. Dave talked in quite detail on Executive Order 2087, which was issued by the governor on May 14th. It also pertains to certain issues with filing deadlines for the tribunal. For example, the executive order extends from May 31st to July 31st the deadline for assessment disputes as to property under Section 34C, which deals with commercial real property, industrial real property, developmental real property, commercial personal property, industrial personal property, and utility personal property. The EO still maintained the July 31st deadline for property classified as residential real property, agricultural real property, timber, cutover real property, and agriculture personal property. The other parts of that have been covered by Dave. Another thing that you should take a look at and watch for, there is a bill that passed the House and Senate and is at the governor's desk. We don't know whether it's going to be signed or not, but it's House Bill 5766. It also extends until August 31st certain types of property tax appeals. Again, if you sign up for our newsletter with Michigan Tax Tribunal, we'll keep you apprised of that. Or you could go to michiganlegislature.gov and type in that number, and you'll see whether or not that law changes, because it does impact some of the deadlines for appeals. The other thing that's happening with the tax tribunal, as many of you know, it's basically two different portions. We do small claims cases and we do entire tribunal cases. The small claims cases starting in April were all converted to telephonic hearings in which the hearing officer would call both parties up at a set time to hear their case over the phone. This was a COVID-19 related response. Prior to COVID-19, we would do them upon request of one of the parties. Now at least through August, all of our small claims cases are being scheduled as small claims cases. Petitioners still have a right to request an in-person hearing. Those cases are being held back until it is safe to have small claims cases in person. In addition, we're actually quite proud of this, and it's another reason to look at our website. Our tribunal cases, the entire tribunal cases, we've had to adjourn the cases from April through June, but we have started with Microsoft Teams platform to initiate several hearings, and we have one scheduled. We have several scheduled already. The first one is scheduled in June 18th, and you can find out information on that by going to our website. Again, I feel like Ross Perot here. I'm not having a banner, but go to our website. There's an icon that says virtual hearings. In addition, we have a guide for participants in the conducting of entire tribunal video conference hearings that's available on our site. And under hearing notices, there's several days that are set for video conference hearings. It also contains instructions how to watch if you're interested in watching. It is open to the public. Ideally, we ask that people register an hour before, but you can join at any time. We just ask for an earlier registration to ensure that you're able to watch the proceedings. None of us know how long this COVID crisis is going to stay and what the severity is, but we're trying to accommodate some of the challenges with that by thinking outside the box, and the Teams platform seems to be offering a very good opportunity for us to continue with our hearings. With that, I'm going to conclude my little 5-minute stretch there.
Thank you, Steve. At this time, I'll circle back to Howard Heidemann to see if he is now online to touch base on foreclosure prevention and mischief forms. Howard?
Hi, can you hear me?
Yes.
Great. Tax foreclosure for unpaid 2017 property taxes on real property became delinquent on March 1st of 2018 were subject to forfeit on March 1st of 2019, and foreclosure becomes, under the Property Tax Act, foreclosure would have become final on March 31st, 2020, except that Executive Order 2020-14 extended the deadline until 30 days after the end of the state of emergency, or March 29th, 2020, whichever is later. Executive Order 2020-99 extended the state of emergency until June 19th, 2020, which delayed the foreclosure deadline to July 19th, 2020. But Executive Order 2020-106 rescinded Executive Order 20-14, and EO 106 specifically set June 29th, 2020 is the foreclosure deadline, unless a circuit court had already ordered the July 19th, 2020 deadline within a county. Note that several counties have canceled 2020 foreclosure proceedings entirely, extending the deadline for delinquent 2017 property taxes to March 31st, 2021. Regarding foreclosure prevention programs, MCL 211.78Q allows counties to create delinquent property tax installment payment plans for financially distressed persons. As long as the required payments are made, the county will withhold the property from foreclosure proceedings. Contact your county treasurer for more information. Also, financial assistance may be available from the website stepforwardmichigan.org. I hope this information helps. That's it for me.
Thank you, Howard. At this juncture, we'll transition to our questions and answer portion of the webinar with some questions you submitted to your associations when registering for the event. To start the questions, I'd like to introduce Dina Bosworth, Director of Governmental Affairs for the Michigan Association of Counties. I'll turn it over to you, Dina.
Thank you, Heather. I appreciate it. So I'll just start with a couple questions that were submitted. The first question is, what can our local units of government expect for PPT reimbursements next year? Will they get their full amount?
Thank you, Dina. I didn't hear the ending part of it, but I believe your question was what they're going to get for next year. Currently, the PPT reimbursements they're based on the Local Community Stabilization Authority Act, and that sets the amount for the year. So currently there is no change in that. Doesn't mean that the legislature can't change it, but it just means that currently that is not happening that I know of. So that is unfortunately all I can really comment on that, because I don't know anything more.
I don't know if any of us do at this point. But thank you, Evie. I appreciate that. The second question has to do with the July Board of Review extension again, or the Board of Review extension to July. So the question is, can a taxpayer submit Form 5278 to the July Board of Review if they had neither timely filed one with the assessor by February 20th, nor submitted one to the March Board of Review?
Hi, this is Dave Buick. Yes, the powers that are granted to the March Board of Review are provided to the July Board of Review. So yes, both the small business taxpayer and the eligible manufacturing personal property exemptions may be claimed at the July Board of Review.
Thank you for
Thank
that.
you. Next, we have Judy Allen, Director of Government Relations from the Michigan Townships Association, that has a series of questions from her membership. Judy?
Thanks, Heather, and thanks for allowing us to partner with the Department of Treasury on this. My first question, I think, is going to go to Dave because it's dealing with reinspection of property. So with the pandemic that's been in process and the difficulty with physical reinspection of property during this time, and an attempt to avoid face-to-face interaction with property owners who might be a little hesitant, would an exterior inspection and a questionnaire completed by the property owners meet the requirements? Would that be sufficient?
In this unheard of time, yes, I think that makes perfect sense. If you look at a neighborhood where everybody's got 3 bedrooms and 1 bath, and then all the homes are built the same, it makes perfect sense. I think it might be a little more difficult for an assessor in a situation where they have a new build, not knowing what's in it, where they may have to do something. But I think utilizing what personal protection and social distancing they can, they should be able to utilize the questionnaire like that. And it all comes down to the assessor's professional judgment. Can they make a good assessment on that property based on the information they have?
Okay, thank you. The second question that I received from one of the members is dealing with the unemployment. And the question I have is regarding the federal $600 FUP program that exists. Will that be deemed taxable earnings at the end of the year? Is the first part of the question. And then the second part of the question is, are essential employees who are underemployed, i.e. furloughed, be eligible for the federal federal unemployment contribution? So 2 questions, if directed to unemployment, please.
So I'll start with the second one because it's easier, I think. As far as that, yes, if the employee receives any portion of unemployment, whether it is on the work share program, whether it's regarding underemployment, or whether it's full unemployment, then they will receive their state or our traditional unemployment amount, and then they will get that $600, and that will be received weekly until July the 30th of 2020 this year. And it is my understanding that yes, these are taxable. The income is taxable. However, in the workshare program, which is what I was speaking of, you cannot have it deducted. So therefore, when it comes around to tax time, you will have to actually pay the taxes on that money. You will receive a 1099.
Okay, thank you.
Okay, we're going to turn it over to
Chris.
Yep, thank you, Judy. We'll turn it over to Chris Hackbarth now. Chris, do you want to take a few of the questions that may not answered during the attendee chat feature? It looks like we got most of them answered, but there might be 1 or 2 in there.
Sure. No, and for those who aren't online, it might not be a bad idea to just reiterate a couple of these that had a common theme as well. The first one of those is from that, and going back to the work share and unemployment conversation. A lot of questions in the chat, and again, appreciate the quick answers from staff. A lot of questions in the chat though about reimbursing employers, and when it comes to either unemployment or work share, what proportion of those costs will be borne by reimbursing employers versus coming out of either the state or federal funds?
So, you know what? We're still waiting for that answer from the Department of Labor for reimbursing employers. For the most part, as with the contributing employers, it will not affect the contributing employers reserve fund. So we were under the assumption that most or some or even a portion of that is going to be the same for reimbursing. For the reimbursing employers, as you know, those are the ones who pay pound for pound or dollar for dollar for the unemployment benefits that we pay out that are distributed. The employer has to pay that back. And during the pandemic, the governor made it so that it came out of our general fund and not the individual employers. So we don't know when exactly that's going to end, and we don't know what the percentage is. I don't know if Yukima has answered that within the chat, but that's something that we're still looking into because it is foggy, and we had to get an actual legal review of that.
Great, thank you.
Hello?
I know. For a lot of our local governments, that'll be important information as your agency has that done and can share that back out. We appreciate that information.
Sure.
Dave or Heather, going back to Treasury with regard to the July board's review, does the department anticipate issuing any specific guidance around operating these July boards review, especially for those local units that had completed their March boards and getting into this, time frames and when they need to open, if they were not planning on meeting, if they had nothing to normally meet on?
This is Dave. Yeah, the State Tax Commission issued the guidance this morning. We'll be getting them out on our listserv. They'll be on our website. There are some specific questions in there about when they need to meet and how long. Since the statute is silent on that, the recommendation from the commission is the boards will have to look and see what they're recommending, that they take appointments so that they can schedule and schedule times accordingly and possibly schedule some evening hours. Because of the due process provision, Commission is recommending that the local units should schedule a board review even if they did complete their March board.
Great, thank you. And I know I saw earlier there were a number of questions on county revenue sharing and similar to statutory revenue sharing for cities, villages, and townships. Eva, thank you for that answer with regard to those are specific budgetary appropriations and are not the county amounts are not subject to the sales tax collection. So that answer came out, but for anybody on the phone who was not able to see the chat box. And I think that covers us, Rod.
Okay, thank you. Howard missed one of his slides during our technical glitches. So Howard, if you want to cover the items related to Michigan and commercial forest forms real quick.
Yeah, for the local treasurers participating in the webinar, we will mail out the MISHDA annual returns next week and the commercial forest annual returns next week. And if you have any questions, the letter will provide contact information. Thank you.
Okay. Thank you. Thank you. I'll turn over here, Heather, to wrap us up. Just a couple more reminders. Again, there's a survey at the end. We appreciate you taking the time to fill that survey out. Additionally, we have information available on our COVID website related to how to file an extension for filing of your audit F-65 or qualifying statement, specifically for those jurisdictions with the December 30th, 2019 year-end date. So again, that information is available on our website, and I also include a link in our chat box. So with that, Heather, I'll turn it over to you to finish us out.
Thank you, Rod. We have reached the end of our webinar. We hope this information presented during this time can be utilized in your community. We'd once again like to thank our speakers, the MAC, MTA, and MML for their continued partnership in presenting today's webinar. As Rod indicated in the beginning of the presentation, today's PowerPoint and recording of the webinar will be available on Treasury's local government COVID-19 updates webpage later this week. We would also appreciate if you take a few minutes following the webinar to take a short survey with your feedback for us to discuss a number of issues, including cash flow concerns and property taxes. But overall, we really appreciate you joining us today, and we wish you all to stay safe. Thank you, everyone.